Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled 2020 Election Playbook, Wealth Planning Ideas and Perspective for All Investors. For those who don't know me, my name is Jonathan Shenkman and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15 to 20 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. This year, I've written 3 articles on the upcoming election. After the program, I'll send out a link to these articles and a variety of other periodicals where I publish my work. With that introduction, let's jump into the program. Most webinars that I've listened to on the upcoming election have covered very specific topics such as tax and estate planning, investments, behavioral finance, or other niche areas. This program will take a bit of a different approach and will touch on a variety of topics. Hopefully by the end, everyone will be able to take away at least a few nuggets of information to implement personally or with your clients. The topics we'll cover include, first, an experiment. I'll conduct a brief experiment related to politics that will require the audience's participation, impact of emotions on investing, offer historical context of presidential elections. We'll discuss the important area of behavioral finance. I'll share practical strategies to overcome your biases. We'll explore possible impact of the markets based on various election outcomes. For the tax practitioners on the call, I'll touch on wealth planning ideas to consider. And finally, I'll discuss advisor alpha, namely how can professional advisors offer value, especially during these presidential cycles. Okay, before we jump into the meat of the presentation, I'd first like to conduct a short experiment. The experiment consists of just 2 statements to consider. The first statement is this: President Trump is the best president in a generation, and he has made America great again. The second statement is former President Barack Obama and Vice President Joe Biden were our country's greatest leaders and helped the U.S. regain its standing in the world. So how do you feel when hearing those statements? Well, before I lose half the audience, the purpose of this experiment is simply to illustrate that politics can cause strong emotional responses for most people. Even the utterance of the words Trump, Obama, Biden can cause people to feel angry, and that's why during every presidential election cycle, I hear the same rhetoric from friends and clients. They say, if so-and-so wins, I'm selling everything and moving to cash. He or she will destroy the economy. Folks on both sides of the political spectrum make similar heated remarks about their intended actions should their candidate not be elected. I even had a friend tell me that if their desired candidate doesn't win, he'll move abroad. His candidate lost, and he ended up leaving the country. However, if history is any guide, basing financial decisions on political elections is the wrong approach. Given this emotional topic, it's important for trusted advisors to overcome these natural human instincts themselves as they act in a fiduciary capacity in order to help their clients make prudent wealth planning decisions. Indulging on one's emotions tied to the political landscape isn't only imprudent, but can also be very costly. Polls and studies have illustrated that political biases impact one's judgment. In a Quinnipiac University poll from August 2019, there was a large gap in how Republicans and Democrats perceive the state of the economy. In the study, 43% of Republicans described the economy as excellent, and another 45% described it as good. However, among Democrats, just 2% described the economy as excellent, and 37% said it was good. Roughly 60% of Democrats thought it was not so good or poor. Overall, 88% of Republicans used positive language of the state of the economy, while only 39% of Democrats did the same. Similarly, a 2017 study in the Journal of Financial Markets found that in the last year of Bill Clinton's presidency, Democrats were more optimistic about the economy than Republicans. However, immediately following George W. Bush's win over Al Gore in the 2000 election, the Republicans became more optimistic. The fact is, we're all living in the same economy, but our political affiliation can strongly influence our view of it. And by the way, professional investors aren't immune from having politics impact their thinking as well. A study in the Journal of Banking and Finance found that political affiliation can influence the portfolio decisions of even those at the very top of the financial sophistication ladder. The study noted a direct correlation between the types of stocks professional money managers select and their political perspectives. This is especially interesting because hedge funds have incentive fees and serve as a motivator to outperform various benchmarks. Letting politics impact your paycheck seems unthinkable. However, despite the incentives, hedge fund managers' thinking is also marred by political bias. I find that historical context can help advisors and investors talk through the political climate in a level-headed manner and provide a data-filled perspective that will guide future investment decisions. In that vein, let's dive into some data. There have been 58 presidential elections throughout history, with the Republicans and Democrats tied at 24 wins each. Note that the 48 total wins by Republicans and Democrats don't sum to the total number of elections because different parties existed in the country's early days. When looking at the data, it's also worth comparing the first 2 years of the presidential cycle to the full 4, because the Senate and House can change halfway through due to midterm elections. According to a February 2020 paper by Fidelity, when the Republicans won the presidency and held a majority in both the House and Senate, which happened 16 times, the 2-year market return was approximately 12% annually. During a Democratic sweep, which occurred 19 times, there was approximately a 3.5% annual return for the first 2 years. However, after a full 4-year presidential cycle, the annualized returns for a one-party sweep were much closer, at 8.6% for Republicans and 8.2% for Democrats. When Republicans won the presidency without a majority in the House or Senate, there was a 2-year return of approximately 1%. On the other hand, a Democratic win under the same scenario has produced a 2-year return of 14.5%. However, after a 4-year presidential cycle, the annualized returns are again similar at 8.7% and 10.9% for Republicans and Democrats, respectively. Overall, factoring in all presidencies, and regardless of whether there was a one-party sweep of the House or Senate, the market did better over the first 2 years when there was a Republican win. Those periods show an 8.3% annualized return as compared to a 5.8% return for Democratic wins. However, over the full 4-year presidential terms, the averages are nearly equal at 8.6% Republican presidency versus 8.8% for a Democratic presidency. It's important to point out there are an infinite number of statistics that one can analyze from the markets. There are also plenty of ways to manipulate the data, such as merely changing the start and end date or reframing the information in order to make a particular point. For example, since 1925, during a presidential year, the market was up an average of 17.9% when a Republican was elected versus an average of down 2.7% when a Democrat was elected. However, during the first year of a president's term, the market was up an average of only 2.6% when there was a Republican compared to 22.1% for a Democrat. The analyst's political leanings could certainly impact whether she chooses to focus on the annual period preceding or following the elections. In the past few months and the months after we know the winner, there'll be no shortage of pundits who will use data to support the point that they want to make. The key for investors is to sort out the noise. Many people on this webinar are probably wondering, what happens if we have a contested election? This is a very real possibility given the heated political climate and the fact that the polls are extremely close. It turns out we have a recent example of a contested presidential election. The outcome of the election between George W. Bush and Al Gore was not decided on election day 2000. Instead, Gore demanded a recount in the state of Florida, where the vote was very close. Does the phrase hanging chad ring a bell for anybody? We didn't know who won the election for over a month until the U.S. Supreme Court ultimately ruled on Bush versus Gore on December 12, 2000. Despite the uncertainty of who would be president the following year, the U.S. stock market didn't sell off dramatically. Between Election Day on November 7th and the Supreme Court ruling on December 12th, the S&P 500 was down only 4.24%. However, it's important to put that election into context. The dot-com bubble began in March of that year, and by the end of 2002, the NASDAQ was down 72% from its highs, and the S&P 500 was down 36%. I suppose we can find a political party to blame for the bursting of the tech bubble, but that would be disingenuous. In reality, no matter what others may tell you, the most important data point when it comes to investing in politics is one that illustrates the power of compounding. For example, if you started investing the total U.S. stock market index in 1979 during President Jimmy Carter's term and cashed out 40 years later in the middle of Donald Trump's presidency, you would have invested through 3 Democratic and 4 Republican presidents. You also would have experienced an 11.5% annualized return on your money. A single $10,000 investment would have turned into over $883,000 by the time of your retirement. Again, one could parse a million statistics to highlight the relative economic benefit of one party over the other. However, the market will persevere regardless of who's in office. Having a system of checks and balances puts a limit to how much power any one person or one party can have. This fact is what makes the U.S. the strongest and most liquid market in the world. The real key for all investors is to understand how their behavior is impacted by politics and implement strategies to overcome those biases. An area that can help folks understand why investors are not always rational when it comes to their money is the field of behavioral finance. The concept of heuristics, which is an individual's tendency to make mental shortcuts to make quicker decisions, can help shed light on this issue. Quick decisions are often plagued by emotions and natural biases, leading to errors in judgment. Recognizing and acknowledging these heuristics can allow investors to improve their decision-making processes and overcome these hurdles. Two heuristics that come up at the intersection of politics and investing are confirmation bias and herd mentality. First, confirmation bias. Confirmation bias is the fact that people are naturally drawn to consuming information that validates their own point of view, while simultaneously blocking out any data to the contrary. This happens independently in the world of politics and investing. The folks who watch CNN will generally never watch Fox News and vice versa. Combining political views with markets and only selectively reviewing information that supports an investor's opinion is a sure way to lose money. In the world of investing, it's fine to look for supporting evidence for an investment thesis. However, it's equally important to look for conflicting evidence that doesn't support one's position. Taking the time to deliberate over both supporting information and data that challenges one's view is ultimately how good investment decisions are made. The next heuristic is herd mentality. Herd mentality occurs when people want to be part of a community with a shared culture and socioeconomic norms. This can apply to being part of a team, place of worship, country club. A community will make decisions based on the shared points of view of its members, and many will share them publicly. These groupthink environments consequently lead to social pressures to conform. If someone's herd is made up of politically like-minded individuals who express their investment philosophy in a particular way, there's a high probability that the individual will express her investments in a similar vein. The truth is that everyone has biases. Even people who claim to be apolitical are swayed from time to time. That's why it's so important to have processes in place to overcome these heuristics and to ensure that your investment decisions remain sound. The following strategies are essential in any fiduciary wealth management relationship and can help advisors and their clients stay the course. The first strategy is utilizing an investment policy statement or an IPS. A well-defined IPS is a wonderful way to clearly define a client's objectives, keep the client on the same page as the advisor, and put the client on track towards achieving their goals. While the standard IPS highlights clients' financial goals, time horizon, risk tolerance, liquidity requirements, tax situation, and income needs, it should also include any specific preferences that the client outlines. If the client is a politically charged individual, then laying out a specific framework for handling her investments during an election year is a judicious decision. However, it's not recommended to highlight specific investments to buy or sell based on the party that's in office. Timing any investment based on the political climate is impossible and imprudent. A good illustration of this is exemplified with the concern over healthcare stocks due to the enactment of the Affordable Care Act. Investors were worried that Obamacare, as it's become known, would destroy healthcare-related stocks across the industry. In reality, there ended up being mixed results with a variety of winners and losers in the space. For example, when President Obama signed the bill on March 23, 2010 through the end of 2013, when the insurance exchanges were open, the top 9 largest publicly traded health insurance companies and the 10 largest pharmaceutical companies achieved 96.8% and 51.5% total returns respectively. This compared to a 52.2% return of the Dow Jones Industrial Average over the same time frame. On the other hand, the 10 largest medical device companies returned only 35.8%, drastically underperforming the other categories. A better approach is to put guardrails on one's investments. Rather than making bold investment decisions based on the party in power, as an example, if a client is concerned that a particular party is in office, instead of going to all cash, an IPS can give the client the flexibility to move a portion of her portfolio, say 10%, into cash. Another strategy is automation. One sure way to eliminate the impact of emotional decisions is to build in a level of automation into one's investment processes. The human element in any financial plan is crucial, but there are many processes that can successfully be automated to maintain impartiality and gain efficiency. One type of automation is rebalancing, which is the process of adjusting the weightings of a portfolio as the investment values go up or down over time. When a portfolio is rebalanced, assets are bought or sold to maintain their original asset allocation, which is based on the investor's risk tolerance. Investors can set their accounts to automatically rebalance at set dates throughout the year. Others may prefer for their portfolio to automatically rebalance once a position grows or shrinks beyond a certain predetermined threshold. Regardless of the approach, the act of rebalancing has the benefit of preventing investors from letting their emotions determine when to purchase or sell existing positions. Another automation is dollar cost averaging, which is the strategy of routinely adding money at regular intervals. The benefit is that it eliminates the desire to time when to enter the market. As an example, during both the 2012 and 2016 presidential elections, I had friends and colleagues move all their money to cash when their desired candidate didn't win the presidency. They thought they could effectively time the opportune moment to take money out and ultimately to put money back into the markets. This turned out to be the wrong decision in both scenarios. Dollar cost averaging takes the urge of trying to time the market out of the equation. It can be set up effortlessly through an investor's 401k plan at work and can be set up for a client's taxable account by working with your financial advisor. Diversification is another strategy to use. Diversification is the concept of having exposure to various investments such as stocks, bonds, commodities, real estate, and alternative asset classes. It also means having exposure to various geographic locations, including outside of one's home country. The beauty of always implementing portfolio diversification is that no asset class is 100% correlated with another. That means if stocks are down, bonds may be up. If one's local market is struggling, other countries around the world may be thriving. Diversification is a powerful strategy because it allows investors to build wealth over the long term, regardless of what's happening in any one part of the market or who's in the White House. You can also set up a play money account. Many advisors view small trading accounts as a waste of time and a sure way for clients to lose money. Over time, I've learned that these accounts actually serve an important psychological purpose. Folks can scratch their trading itch without blowing up their entire portfolio. During an election year, an investor can set aside a small portion of their investable assets, figure no more than 5%, to invest based on their political preferences. If things work out, then great. If they don't, the remaining 95% of their portfolio is still structured prudently. And the final suggestion to help keep your emotions checked is to appoint your own investment committee. In the world of institutional money management, many organizations establish an investment committee for proper oversight of their investments. It's equally important concept for individual investors. Find unbiased, knowledgeable people, ideally outside of your social circle, to minimize groupthink, to bounce ideas off, and to challenge your investment thesis. The exercise of discussing your investments before executing them helps minimize emotional decisions based on your own political and personal biases. Now let's explore two possible outcomes for the market based on which candidate is victorious. Even if we can't predict exactly what will happen based on the party in power, we can still mentally prepare for various scenarios so there are fewer surprises that may rattle us as investors. The first possible scenario is the blue wave. Should Biden win the presidency and the Senate flip to Democratic control, most would expect at least a moderate rise in corporate and certain individual income taxes and a larger rise in federal spending to fund more fiscal stimulus, healthcare, and environmental policy reforms. However, a Biden win with Republicans hanging on to the Senate raises the risk of deadlocked legislative and budgeting process. In the recent past, this power struggle has led to a negative contribution to GDP from federal spending and investment. Under a Biden presidency, it's likely that the Fed chair, Jerome Powell, will receive another 4-year term or be succeeded by someone with an even more accommodative monetary policy. Trade and foreign policy would become less volatile with a greater emphasis on multilateral action, even as skepticism about globalization grows increasingly bipartisan. So how does that impact various areas of the market? Well, with stocks, renewable energy, electric vehicles, infrastructure, and firms with large international exposure would likely benefit, given trade risk should de-escalate. Less tax-sensitive sectors like utilities could also benefit. In the world of bonds, new deficit spending will lead to a weaker US dollar, and Treasury inflation-protected securities, or TIPS, should outperform. Emerging market debt could benefit from less tariff-related uncertainty and appreciating currencies. For municipal bonds, a unified Democratic control would likely result in more federal assistance to state and local governments, and higher tax rates would increase demand. Real assets like natural resources should benefit, including forest infrastructure investments tied to sustainability and climate change, and industrial real estate oriented around production onshoring. ESG, or environmental, social, and governance-focused investing, should experience a friendlier regulatory environment for investors and issuers with policies focused on climate change, carbon reduction, and income inequality. Should President Trump be reelected, I would expect the Senate to also remain in Republican control and Democrats to retain the House. This outcome should trigger price action similar to what we saw in November 2016, when high-tax companies and those with greater regulatory risk outperformed. Fiscal stimulus would not be quite as loose, given growing concerns among Senate Republicans about deficits. However, a bipartisan stimulus plan around infrastructure would be on the table. Additionally, trade policy would remain unpredictable, since more and higher tariffs are a strong possibility. This should impact various areas of the market as follows. For stocks, cyclical sectors that benefit from discretionary spending and small cap companies with a high percentage of revenue generated domestically would be likely winners, as would firms with high tax burdens or high regulatory risk. When it comes to municipals, lower tax rates and federal government less inclined to provide direct support to municipalities could create issues for select areas. But overall, solid fundamentals and strong supply-demand dynamics should still support municipals. And the U.S. dollar would likely remain strong if concerns center on trade policy uncertainty and a broad decline in global trade flows. For real assets, low taxes and rates would be a positive for commercial real estate. Industrial real estate may also be interesting, as it's more leveraged to e-commerce and less leveraged to trade. Again, while all these are interesting topics to pontificate upon, your investment strategy should focus less on what sectors may do well under either administration and focus more on the best way to achieve your long-term financial goals. As much as I like to discuss investing in the markets, some of the major financial planning opportunities are a bit out of my wheelhouse in that they focus on taxes. While I'm not a tax practitioner, it's imperative that your financial advisor can work closely with your CPA and estate planning attorney to seamlessly implement some of the strategies I'm about to mention. The first area to focus on is federal income tax rates on long-term capital gains, which are assets held for more than 1 year. Under Trump's 2017 Tax Cuts and Jobs Act, the maximum capital gains tax rate was not changed. The maximum federal long-term capital gains rate is 20% for 2020. This applies to incomes over $434,550 for single taxpayers and $488,850 for those married filing jointly. The net investment income tax of 3.8% applies to the total maximum rate is 23.8%. Under the Biden proposed plan, for tax filers with income over $1 million, the long-term capital gains will be taxed at 39.6%. The net investment income tax of 3.8% will apply for a total maximum capital gains rate of 43.4%. Some planning opportunities are worth considering for those who are in the market to sell a business or sell a large holding of investment assets, since they may be subject to much higher income tax rate. Planning considerations include the sale of business interests may reduce by selling ownership in installments. In any year in which a large gain is anticipated, timing or bunching of charitable or other tax deductions may be advantageous. One may delay harvesting capital losses potentially planned for the tax year 2020 to a future year when anticipated tax rates will be higher. Consider selling appreciated assets in the current year if current rates are anticipated to be lower. And you could use a charitable remainder trust for diversification and tax mitigation of highly appreciated assets. The second wealth planning area to consider is federal income tax rates on ordinary income. Under the Trump Tax Act, the tax brackets were changed with the top bracket reduced to 37% maximum federal income tax rate. Under the Biden proposed plan, the maximum federal tax rate for the highest tax bracket will be increased to 39.6%. It's important to note that currently qualified dividends are taxed at preferred equivalent long-term capital gains rates. For tax filers with income over $1 million, qualified dividends will increase from 23.8% to 43.4%, meaning the dividends will be taxed at ordinary income tax rates. Some planning opportunities and key considerations involve the lower current ordinary income tax rates, which are scheduled to expire or sunset as of December 31st, 2025. If this occurs, the top rate would revert to 39.6%. However, the qualified dividend rates are not scheduled to expire. Some planning ideas include carefully consider the timing of income recognition and the use of available tax deductions and credits to determine how acceleration or deferral of these items may be most advantageous. You can also consider contributing fully to all tax advantage accounts, such as health savings accounts, 529 college savings accounts, and retirement plans. The final wealth planning area I'm going to cover is the stepped up income tax basis upon death of an individual. Under the Trump Tax Act, the law did not change. For most assets that are non-retirement assets, the income tax basis, or the amount one paid for an asset, is adjusted or stepped up to the fair market value of that asset as measured on the date of death. This permits the family or beneficiaries not to incur capital gains upon the sale of the assets if sold at the fair market value. Under the Biden proposed plan, there may be an elimination of the stepped up basis adjustment. Some planning opportunities include the importance of maintaining records in order to determine or compute historical income tax bases, which may be very difficult to obtain or recover. It may be prudent to evaluate whether individuals or their heirs will pay greater capital gains tax on the sale of assets. For example, it may be more tax efficient for an individual to sell assets prior to passing to pay expenditures such as large deductible medical expenses or charitable contributions rather than passing the assets to their heirs to later sell. For individuals subject to state estate taxes, there may be an opportunity to sell assets prior to death, so one's gross estate is reduced by the income tax liabilities incurred. You should review existing estate planning strategies and documents that presume that the stepped-up basis is still available. A removal of stepped-up basis may substantiate the decision to make a Roth IRA conversion. And donating appreciated assets to charity during your lifetime may also become more relevant. Over the past few months, one of the big reasons some investors have been hesitant about investing is because they were waiting until after the US elections. This is the wrong approach. It's important to remember that there are a variety of factors beyond just politics that may affect the movement of stock prices and one's wealth. These include stock fundamentals, earnings, interest rates, labor growth, market sentiment, tax policy, and geopolitical issues. To give any politician full credit for market performance, whether good or bad, is disingenuous. However, planning ahead to insulate your wealth from your emotions and a variety of unfavorable tax policies is prudent. As the presidential election nears, it's also important to appreciate that the advisor drives the ultimate financial outcome far more than any politician. I call this advisor alpha. Advisor alpha is the value that financial advisors, attorneys, or CPAs bring to clients to increase their likelihood of success. An advisor will communicate to a client regularly to guide them through important issues such as cash flow management, investment options, risk tolerance, time horizon, asset allocation, tax minimization, insurance coverage, and legacy planning. They'll also tweak the financial plan as life or the economic environment changes. Through it all, they will endeavor to prevent clients from making emotional decisions. So in short, an advisor can help immunize a client's portfolio from political bias and ensure the client is on track towards achieving their financial objectives. If you or your clients are unsure about next steps to take to protect and grow your wealth, especially during an election year, always feel free to reach out to me directly. And with that, this concludes today's session. But before I let you go, my next program is on November 9th at 8:30 a.m. and it's entitled Federal Taxation with Proper Representation, a primer on IRS civil and criminal tax controversy, featuring Richard S. Kestenbaum and Scott Kestenbaum of Kestenbaum Mark LLP based in Long Island, New York. You'll be receiving an email tomorrow morning with more details and registration and information for this and all of my upcoming programs. There's also a short survey at the end of this program to get an idea of what you were interested in hearing and what you'd like to hear more about. I hope you could attend my future programs. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.